Good afternoon. I'm Andrew Chin. I'm a director of the SQA. So our next speaker is Ronnie Sadka from the Carroll School of Management at Boston College. He's a senior associate dean and chairperson of the finance department. I first met Professor Sadka about 5 years ago, and I thought he would be a great speaker for this conference because he had this great combination of being a great professor who's published a whole lot, and he actually has been a former quant, right? So what a perfect combination. He was also one of the first academics to study the impact of the media and sentiment on the financial markets. And he continues to do innovative work on asset pricing, liquidity, and behavioral finance. Professor Sadka's work has appeared in various journals and news publications, and he has taught at business schools at University of Chicago, NYU, Northwestern, and the University of Washington. Please help me welcome Professor Sadka.
Hi, everyone. I'll just make one correction. I'm not a former quant. Once a quant, always a quant, right? All right. Well, thank you very much for inviting me here. It's really nice to be here. I tried to look last night when we had dinner, see when is, I remember I presented already at the SQA, and well, when was that? I look at my emails, and it was back in 2006. And it is a real pleasure to come back and talk about a whole different type of research. Back then it was liquidity risk, transactions cost, and now I work on a different topic. It's funny, a lot of my colleagues that were working on that area at the time, about a month ago I went and presented this work at the Treasury Department, and suddenly all of us guys that we're working on microstructure, suddenly we're working on Bitcoin, cryptocurrency, big data. So I guess it's I'm in good company. I also want to thank the organizers for not using the words big data in the title of this conference, right? Because anyone here doing small data? Anyone small data here? Everyone's doing it, right? If you're not doing it, you're not going to admit it. So anyway, I want to talk to you a little bit about, I guess, a new line of research for me. I've been working on this for about 7-8 years now. And I would like to share with you some of the insights. I'm going to focus primarily on results of a new working paper that I have with a bunch of other authors, Ken Fruit and Xiaoxia Lo and Gideon Ozick, myself, and C.E. Shen was my student in BC. So there's a lot of people in the project because it's hard to do, hard to be small with big data. So you have to have a lot of people contributing. I think media research in general, it's a very interesting place to be. When you think about media, it's a place where a lot of information comes out in the media. People try to digest it. Investors trying to understand what it is. And then everyone kind of use that information and come up with their investment decisions. The academic research has primarily, I think, focused on direct effects. What do I mean by direct effects? So, people look at sentiment analysis. So they look at the words and bag of words or some kind of any natural language processing algorithm that you like, and you can kind of look at the sentiment. And then what people typically do is they look at the sentiment and try to predict, forecast returns with it. And people do it high frequency, low frequency. A lot of different works that I've seen that try to do that. I think it's not easy. I think people have done stuff with predicting, let's say, trading volume or looking at aggregate results. And there's a bunch of academics to do that. What I'm going to focus on here today is something different. I'm going to try to look at interaction between media and financial markets. I'm going to try to look at interaction effects. I've also done some stuff on direct effects, which I'm going to talk to you about, but most of the results are going to be on the interaction effects. And this is also a new place for me. Usually I've worked on individual firms, individual stocks, but now I'm going to also show you some results about aggregates, so like currencies and country equities. I also worked on commodities, but it's not in this, I guess, in these sets of slides. And the same, I guess, fact that we find for equities, we find it for all of these different asset classes. So we think we found something really robust. It's hard to get robustness with this new age of data because you don't have a lot of time series. You need to be comfortable with a short time series. It's not like now you have the book to market ratio from the 60s and the momentum trading, you can look at prices for a long time. A lot of this stuff is going to be from less than 5 years. So the way to get robustness or to convince myself that I have something is just looking cross-sectionally more and looking at more asset classes. So what is the idea behind this paper? So I'm going to tell you the result first, or the theory first. I'm not sure how you want to call it, but then I'll dive in more in details after. So what we're trying to do here is to introduce a new concept. And the idea is we think we are able to detect over-pessimism or over-optimism in the marketplace. And the way we're trying to do that is using the media. So there's different ways to express optimism and pessimism. So one way is just look at asset prices. If investors believe that there's some kind of good news or they're optimistic about a particular firm or currency, what's going to happen is that the asset price is going to increase. So I can observe asset prices and I can interpret it as some kind of optimism, right? But another thing I can do is kind of look at the media. And if the media is saying good things if the media is expressing positive views about the asset, that's another indication. What we're going to show you is that when the financial markets and the media agree, okay? So let's say asset prices go up during a week, and when you look at the media, they're also very positive about the asset. These are typically situations of excess optimism. It's like saying you're too late to the party. And what happens, prices depreciate after that. So what we find is a strong reversal when both of these agree. So positive becomes negative. Negative, so when prices drop and the media is very negative about an asset, typically that leads to a reversal. And I'm going to show you that across many different assets. So let's talk first about, in more general terms, about the media. Because I think in the media, there's a lot of interesting things to say about the media. And I want to share with you a few of the insights that, along the way, we have uncovered. So, just to give you, some perspective, we've built some technology that is able to tap into online sources. Right now, we're getting about 100,000 articles per day about different financial assets. Okay, so there's a lot of information. And I think before you even use the data, you need to understand what it is. Because people are paid to produce information. So maybe not all information is useful. Maybe it's just the journalists, they just have to produce something. So we need to understand that. We spend a lot of time discussing the fixed effects, okay? Or I would say, some biases that we have, that the media has, and we try to correct for them. So the type of information we have, just saying, we have 100,000 media articles, it's about 50,000 different online sources that we're tapping into. That's not helping. Once you say more than 10, it becomes, you don't know what it is. So let me try to classify this into different categories. So the way we think about the media, we're thinking about 4 different types. There's going to be general media, like the Wall Street Journal and New York Times, USA Today, Washington Post, etc. That's one type. It's more kind of general media. The second type is specialized media. So this is information that comes from the industry. Pension Investment Magazine, Absolute Return Magazine. All right? A lot of our sources come from this category. Okay? It's people like us in the industry talking about the industry. I think it makes sense that we have a different take on assets. So maybe we need to look at this source as a different type. The third type is information that comes from the companies, press releases. Press releases, we have to distinguish press releases and let's say the other type of the media, because this is information that comes from the companies. Of course, there's a lot of biases, what they choose to report, when to report. Typically, it's positive sentiment, right? They want to avoid negative news, so that's a different type of media. You can't just take an article from this type and another type and just treat them the same way. And the fourth one will be the social media. So we've looked at Twitter and stuff. I think many people try to do that. a lot of it, I'm not sure I believe, but we use it as another source. And so let me tell you a little bit about the fixed effects that we found. Because I think there was kind of, when we looked at it at the beginning, we said, oh, really? That kind of makes, it's interesting. Let's try to understand what's going on here. So before we get into any sentiment analysis, I think it's really interesting that there's systematic patterns in the data. I'll give you an example. The results suggest that, I'll just give an example, that let's say IBM, it's not a real example, but this is the interpretation of the data. Something like IBM is mentioned every third Wednesday of the month. If you run some kind of regressions, and you can see with time series regressions or whatever pool, you can find these systematic patterns. Different firms are mentioned by different media outlets on particular days of the week. And when we thought about it, we said, really, how could that be? But I think one explanation for this is exactly this idea of being paid to produce information. You have analysts, you have journalists. They need to write, they're getting paid to produce information, all right? And I'm sure all of you have seen movies where you have the editor coming, knocking on the desk of the journalist saying, hey, give me something. I don't have anything, nothing happened. Well, write something, 1,000 words, just write something. Well, okay, I follow I follow, let's say, 10 firms closely. I'll just write about one of them. Right? It could be. So we know how to correct for these fixed effects because we know that there's a systematic pattern in the way firms are mentioned. So not all news is new information. Apple is always mentioned in the media. So let's say it's mentioned this month 10,000 times. Is that a lot? I don't know. It's always mentioned. So you have to kind of demean it and look at the historical numbers and then kind of look at the differences and change and look at whether it's abnormally mentioned in the media. Because no one mentions any utility company. They always mention Google and Apple. So you have to make these adjustments. So these are just examples of fixed effects in terms of the sheer mentioning of a firm in the media. But there's other examples for biases like the sentiment. Some journals are just negative sentiment. Does that make sense? Some people are negative sentiment, but we don't want to go there. Some journals are negative sentiment. Let's say Wall Street Journal. I've lived in New York before. It's a fantastic experience. It's twice in my life. Great place. I don't know anyone that likes to read about their neighbor that lives in the next penthouse. So you're already living in a penthouse. But there are 5 penthouses in each building, right? You have 5 different keys. And then the way it works is you have a penthouse and then a smaller penthouse, right? It's beautiful in New York. But you don't want to be in one penthouse and then looking over someone else, right, your neighbor, and reading in the journal that they're doing better. I mean, negative news sells. So we have to adjust for these kind of biases. And information that comes from the industry is typically more positive. Information that comes from the firms, even more positive. So you have to make these adjustments. I'll give you another example, last one. So I've also lived 3 years in Seattle, Washington. Now, Seattle is kind of owned by Microsoft, right? Somehow, like each place in Seattle, like indirectly, there's some connection. No one writes anything negative about Microsoft. It's just not going to happen. Just forget it. I live next to the Seattle PI. They're never going to write something negative. So what you do is you can kind of compare the Seattle PI versus New York Times and try to understand from there. So the more distant the media sources from the headquarters of the company, that's probably going to give you a better signal of what's really going on. So that's just to give you an example of all these biases that we see in the media. You can't just take a media item, look at the sentiment, and go trade. And it's not going to work. I mean, you really have to understand the data before you even start. So we work a lot about that. And some of these effects we're going to correct for this paper. Some we don't, but I just wanted to give you a flavor of the type of things that we look at. For this work, we're going to look at a variety of assets. We're going to look at FX and country equity. So we have developed markets, we have emerging markets. We have media coverage about the currencies. We have media coverage about the equity indices. We have, we're looking also at large cap firms and their media coverages. I also mentioned we looked at commodities. It's not, I didn't include these results here because of time constraints. And then we use some textual analysis to understand the content and whether the sentiment is positive or negative. Now, I can tell you that in terms of just understanding sentiment, I know many people are working on different ways to kind of look at textual analysis. I've looked at several of these NLPs. I built my own as well. I didn't really find, well, let me say it this way. Adjusting for the fixed effects gave me a much bigger bang for the buck than looking at the exact sentiment NLP scoring. And I also tested it with, some of my students. And I just let them read 1,000 articles and score the sentiment of the article, and then when I look at the correlation of that score with all the other NLPs, it's always above 50%. I mean, when it's a negative article, you get that it's negative. So it's not that there's no value in understanding, applying some machine learning or guided machine learning, I like to say, to understand different topics and different sentiment for different topics in the same article, and that's important. But for what we're doing here, we're just looking at general sentiment for an article that mentions a particular asset. To give you some idea of how the data looks like, so I apologize, this jumped a bit because I think this is the PDF. I think I also sent the PowerPoint. I don't know if it's there. Doesn't matter, don't worry about it. But just to give you an idea of the sample, I can tell you in words what you should be seeing here. It's about 100K articles per day. There's a few million articles, I think it's about 1.8 articles over the past 5 years for the country equity in the FX. I don't know if we want to go too much into to the numbers, but it's a really interesting data set. It has a lot of different things we can look at. We haven't looked at all of it yet. But the point is that I want to make is that it is really kind of a large data set that includes a lot of different assets. So before I kind of show you the results, I think I want to convince you that what we are finding in terms of sentiment makes sense. So this is probably the most difficult slide for me to present. So I'll share something about myself. So there's some colors I can't see. Anyone else has this condition? It's only with male, by the way. And it depends on the colors, So that's why my co-authors made sure that I have something written down, so don't forget what it is that you're supposed to see. So there's supposed to be a scale, green is very positive and red is very negative, and then there's kind of in between. And what we did here is we displayed the sentiment for different countries. Okay, so this is going to be for country equity. So we have about 30-something countries, and this is for the country equity. We look at all the articles we have for a particular week. So the way we constructed this is we look at changes in the sentiment over a week. We look at all the articles. This is not like a high-frequency thing. You can look at any given point of time, look at the entire last week, take a look at all the articles, sentiment score them, look at the changes from the previous week, and plot it. And this is the result. I'm going to show you this for 3 different events, just to make you more comfortable with the data. So the first event that we chose was Brexit. Brexit, June 23rd. Here's what you see on top is right before, so during the day of the vote, and then when the result of the vote came out, that's the day after, that's the bottom panel. So I think what you see here, what you're supposed to see, is that leading up to the event, there's a lot of green going on. Okay? And when Brexit happened, and I think it was a surprise, then suddenly you see more red. Okay? Now, I did note there that Russia and China actually exhibited positive sentiment. Okay? There's no political statements here. I'm just showing you what the facts are, what the data is. Okay? This is what we find. So at least give you at least one example where I think the sentiment that we're measuring kind of makes sense. Another one, November 8th, 2016. Remember this day? I remember exactly where I was that day. I was having dinner down in Miami. And we're looking at, I think it was CNN. They had that gauge to show, there was Clinton and Trump, and the needle kind of every hour. So we're having, I don't know if it were the drinks or the food or what, but suddenly, like every hour that passed, the needle kind of went more down towards Trump. And I went to sleep around 1, woke up at 6, and boom, he got elected. I was shocked. So I think everyone else was shocked, because when I look at the sentiment of the media, leading up to the results, there's a lot of positive, I think a lot of green, and then the reason why you don't have here U.S. by the way is because this is for the FX, so it's all relative to the U.S. So this is all kind of currency pairs. So what you see that there's a lot more negative, more red after the election, but surprisingly, maybe not surprisingly, Russia and Turkey was positive. There's actually another country that was positive. It's too small to show here, but it was Israel. That was also positive. Being an Israeli, it kind of, I think I understand where that comes from. It's not, it's probably consistent with my priors for why that was displaying positive. So that's another event. The third event that we chose is the election of Emmanuel Macron. And I think that's also kind of, this was after the first round when people realized it's going to be him versus Marine Le Pen, and people understood that it's probably going to be him. And then you see more positive. I'm not sure why Portugal, for example, is negative. I'm not sure. But these are the results. So what I tried to do here is kind of explain, look, here's how we measure sentiment. There's a lot of more details that go into it. But at the end of the day, I think what you see makes sense. And now I want to take this and run with it. I want to show you what happens when I combine this, interact this with market prices, and show you the results using these double sorts. So now we're going to do some asset pricing tests. What we're going to do is I'm going to form ladder portfolios. I'm going to look at a cross section. Let's say take the FX. Okay, so I'm going to do this separately for FX, and then maybe for developed countries and emerging markets, and then maybe for country not just FX, but maybe country equity currency, equity indices. It doesn't matter how you do it; you're going to get very similar results. So I'm just going to show you a few. So we're going to take the FX. We're going to have their 12 developed countries, and we're going to double sort them twice, once by past return in the last week, and then double sort that by past week sentiment. And then we're going to look at what happens in the future. So we're going to look at the formation horizon is 5 days, holding horizon is like 2 weeks, 10 days. And we're going to do this in a ladder approach. So every day we rebalance 1/10 of the portfolio. I think people are kind of familiar with that, Jagdish Titman, all that stuff. The data is from 2013 to April 2017. I recently updated it. It's fairly consistent. So here are the results. Let me help you read these tables. Let's look at the FX developed first. When you divide by the, let's say, columns, you have the low return and high return. Okay? Here, do you guys see the, okay. So look, you got these two numbers together versus these two numbers. You do these two minus these two, that's the reversal effect. Okay? That's just plain reversal. This is no media here. Divided into two groups, you got the high minus the low, you get a reversal. We uncovered, I think maybe it's known, a reversal in the short run reversal in the cross section of FX. Okay. Now, to understand better the impact of the media, what we do is double sort. So within each group of the high and the low, each of them, we further divide into two groups according to sentiment measured over the last week. High sentiment, low sentiment. So these are dependent sorts. And what you see here is that a lot of this reversal is happening when the media and asset prices agree. So the high is the one where you see most of the reversal. The low is where you see most of the reversal. So if you do the diagonal, you do high minus low, you get this result here. Okay? So what I'm trying to say here is that the reversal effect strongly comes from the media. Now I'm going to convince you that it's not just that I'm double sorting by the same thing. It's not that the media and return, I'm going to show you that it's not that I'm kind of double sorting by return and the media and return are highly correlated, so I'm kind of sorting again by return. That's not what's happening. Okay? When you look at the contemporaneous correlation between return and media, it's statistically significant, but it's not really high. It's not really high. So that effect is happening in FX develop, happens in country equity. The numbers in the square brackets are the T statistics. Again, these are daily returns. So we're extracting this from the daily returns. The numbers here are annualized returns. You just multiply by 250 or 252. So you can appreciate, I guess, the magnitude, the difference when you incorporate information from the media. It's quite significant. If you want to see this in event time, sometimes a picture is worth more than 1,000 words. So you can just look at the picture, and in event time, you see the same thing. You have here two different scales. Here's, this is return. The date 0 is kind of when I'm sorting the portfolio. The portfolios. I have 4 portfolios: the high, the low, and then the interactions. The low, high, low. What you see here are the returns leading up to that date 0. So I'm sorting by that variable. That's why I have two different scales. Of course, that scale is going to be much higher. And what you see here is both high returns, regardless whether the media was positive or negative, you see they're right on top of each other. That's what I meant, that just by looking at the different return, you're not really capturing the media information. The media brings you really, it's additional information. It's not completely orthogonal. I told you there's some relation, but certainly seems to bring some more information. So when you sort on the high, you see that the high is the one that is reversing. The high-low does not reverse. Same here. Low is the one reverses. The high-low stays the same place. So the point is the reversal is really coming from this idea that when you look at the two things together, when optimism is expressed both in the media and in asset prices, it seems that it's time to short, because it seems that there's over optimism or over pessimism in the market. These kind of graphs I can show you time and again for the different asset classes. I'll show you maybe a few more to convince you. Before I jump into equities, we can kind of look back at Brexit, and we can see a nice, it's kind of, I don't want to just, eyeball, but I think people have asked, how does it look around Brexit? And you see exactly what you should, what you expect. Here's the pound USD and the euro USD. So you see how both of them kind of dropped around the event. This is the FTSE 100 and the Stocks 50. They also dropped. The additional information here is the sentiment. So this is the sentiment of the pound and the euro. And I guess the point is that once that shock happened, and you see that both, let's say both can look either in currencies or in the country equity, but both exhibit a significant negative return here. But sentiment was also very negative. Negative, we said it's going to jump up. And that's kind of what you see here. Again, I know it's eyeballing. Okay? It took me a while. I mean, I come from this high-frequency data. Now, dealing with just 12 developed countries was hard for me, to be, as it is. But I just wanted to appreciate that it seems that it's happening in the data. You can do the same thing for equities. So if you do it for individual firms, you get the same thing. We have more power here. We're looking at S&P 500 primarily here. And I guess if you're doing more traditional asset pricing, quant equity, this is something that you feel more familiar with. You get much more statistical significance looking at the individual firms. So here you really have about 100 plus firms in each of these double sorts, a significant number of firms, and the results are certainly certainly there. If you do the same for the event time, again, you find that the high is the one that drops, the high-low stays the same place. Same thing here, low is the one that reverses, low-high kind of stays flat. So really what we're trying to say, again, the reversal comes from this interaction with the media. We did some additional analysis. And I'm not going to show you here everything. We're going to show you a couple. But you can calculate everything with risk-adjusted returns. So you can adjust for all the factors that you'd like. It's not really correlated with the factors. There's different factors for FX. We did that too. You can look at regressions. So you can do Fowler-Macbeth and kind of define the quintiles and do Fowler-Macbeth there. And you get very similar. I think when you see the picture, it kind of gives you the whole story. But you get same significance when you look at Fowler-Macbeth, because then you can kind of control for other things. And you can appreciate that a lot of these things are higher frequency. The turnover is high. So it's not going to be captured by size, book to market, anything that's kind of stale earnings. It's not going to capture that. This is much more higher frequency. The effect is stronger when we look at local media. So I told you we have different types, and it seems a bit stronger when we look at local media. It's stronger for large caps. So even among the large caps, we look at the top 100 firms of market cap, it seems much more stronger there. I think it's consistent with several hypotheses, but at least one of them is that I think we have better information for the large caps. When people talk about media coverage, you have to remember that most of the media coverage is about U.S. stocks, and among them, it's about the S&P 500. You don't really have a lot of media mentions for the mid cap and low cap. Certainly for international, there's also not a lot of media coverage. So I think we'll get a better signal for these firms, and that's why we find a stronger effect there. If you want to appreciate how it looks in some figures, we looked at the, again, U.S. equity stocks, and we can differentiate between, let's say, we did two things. One is we looked at the amount of coverage. So when we have a lot of coverage, so we calculate sentiment as the average of all the articles. But what happens when you have a lot of articles and the N is high versus the N is low? And the other thing we did is we looked at whether we're looking small cap or large cap. And what you see here is that when the N is higher, you get more reversal in the high reverses more, the low reverses more when you have more coverage. So we think we're able to better extract the signal of what the really true sentiment is in the market. Same thing when we look at large caps versus small caps. The reversal effect is stronger among the large caps, both on the high and the low. One thing you can do is kind of put everything together, and how would that look like if you look at the country equity and the FX and the stocks, and kind of put them together, volatility weighted strategies, put them together. This is by no means a complete and accurate backtest, but you just put all of them together because of the low correlation. I think you can get something pretty attractive. So let me summarize here. I think we all agree. I certainly think that the media is a really fruitful avenue for research. There's a lot of different things that still need to be done in the media. I think we're just scratching the surface of it, because there's a lot of things we can do with some of the techniques that were shown today with machine learning, trying to understand different topics, what people are saying about the different topics. There's a lot of different things one could do. What we try to do in this piece of research is to highlight this reinforcement effect. What I think we didn't do, and we stopped short of it, but we're working on it, is we didn't really talk about, is one leading the other? So is it the media generating the return, or the return generating the media? We kind of look at it contemporaneously. And we said, okay, if the returns go, if the asset appreciates in price and there's positive sentiment, here's what happens. But we didn't go and kind of look at whether it's the media causing the return or the return causing. So I'm sure there's kind of a feedback effect, which we didn't look at. We're now working on it. We're trying to do some greater causality tests, but we haven't, I don't have any results to show you yet. So we stopped short of doing that. So if I just want to set the expectations straight. We don't have a lot to say about kind of, this feedback effect between the media and returns. But what we could say is that if you combine them, you get better predictions. Good. So let's start with questions. Please, sir.
You mentioned the local media use, for example, the Seattle Post Intelligence Survey, maybe tends to run a lot of concept reports or articles on Microsoft. I was wondering if you can capture the fact that local papers often report planned closures or layoffs or unexpected executive departures ahead of the national media. At least that's what I imagine.
It's a good question. So I think the nature of the question is, who who comes with the article out with the article first, right? And with who comes with the information out first. We haven't dealt with it a lot. We haven't. I think that's very important if you're trying to understand, if you're trying to do a little bit more higher frequency, and you're trying to understand whether the information is already in the price, and which you should you tap into the Reuters feed or the Bloomberg feed, who's coming out with the information first. We didn't take that approach. What we're doing is we're putting much more emphasis on the analysis. So we're collecting all the information. At any given point of time, we cut. We look at the wealth of information we have in the last month, and then we analyze it. The reason why I think you find predictability part of this is because I don't think people can read all these articles, adjust all the fixed effects. So it's true that we're taking our time in the sense that we're looking at all the information and we're analyzing it, but it's very different than looking at alerts. So that's kind of the only, it's philosophically, I think we're taking a different approach. It's more analysis versus trying to play the game as who's going to be first. We're not trying to do that. Thank you. Please.
Yeah, I was unclear on your slides. When you talk about high and low sentiment, are you adjusting for whether that sentiment is reinforcing the price action and correlated with the price action, or are you just looking at the volume of news flow about a particular?
Okay, neither. So let me just make sure that I explain well. What I'm looking at high, when I say high sentiment, high media, is the sentiment is positive. So I'm sorting by the sentiment scoring. So sentiment scores, there's different ways of doing it. So you can divide into continuum between -1 and 1 or 0 and 1. And then for each article, we score it. And then we kind of look at the average of the sentiment across all the articles that mention a particular asset. And then you have a number. And then we sort the assets by that number. So cross-sectionally. So in some sense, it's correcting for overall global sentiment because we're cross-sectionally sorting it. And those at any given point of time that have high sentiment, we call them, that's the high. And then I'm looking at that, those and the assets that at the same time appreciated the price. So those that were high, that means they went up in the last week, but also media was very positive about them in the last week. Those are my high. The low are those that are depreciated in price, but also this media sentiment was negative. Actually, the changes in the sentiment was negative. Thank you. We did the changes. We found that there's daily effects, so we did changes by the day. So we adjust for the same day of the week. Okay, weekend articles could be different than weekday articles. We found that too. So that's why we adjust the fixed effects are for the day of the week. Please.
Looking at the Brexit example, Russia and China has an opposite sentiments than the rest of the world. But look at the data sources. It seems like Russia and China is not part of data source. So is that the other countries' mediums describing China or Russians' response?
So I'm not sure. I don't think I mentioned what are the data sources. But
I thought the page before that has a data source by country.
Here?
Yes.
Yeah. So this is I don't want to get into it too much, but this is just one. I looked at our panels and I kind of did a snapshot. So this is not an exclusive. This is not all the sources that we are looking at, but we could. So let me say this: our source is primarily in English speaking. Okay. Now that doesn't mean we're just looking at U.S. domestic sources, because Le Monde, Figaro, they have they have English language website as well, so we can get French news from via the English website. But it's true that we're looking across all the sources, and then we're isolating. We're looking at these sources, each article, which entities it's mentioning. So it could be domestic U.S. domestic media talking about Russia. It could be. Please.
Did you use volume as a control? So for instance, contemporaneous volume as a control.
We did use in one of the tables. It certainly doesn't. It doesn't explain the effect. I think you can do better by even triple sorting by volume, because what you would say then is that you can try to capture not only the media piece of it, but also the attention and how much people are responding to the media. So that's something I don't think it even made it to the paper, because it's hard to triple sort when you have 12 assets. But certainly for the equity part, we did that. And from what I remember, it went the right way. So when you had a lot of volume and sentiment is, let's say, sentiment negative, a lot of volume and return is negative, that means a lot of people are trading negatively and the media is very negative, that's when you see more jump up. It's true, but I think it's hard to, again, we only have for that 500 firms. So it's going to be hard to make statistical inference.
But in that exercise, when you included, let's say, volume as a control in your regressions, did the effect on media variables go down? Or
No,
it did not.
No.
Okay.
I don't remember all the results, but it didn't go down. I think the more interesting part is trying to use that as a better measure of how much the market reacted to the media, right? I mean, another measure you can think of is the search, right, that Paul talked about before. I think you can think about, well, there's search, there's media. I like to think about it as supply and demand for information. But it's hard to think about it completely because there's a lot of endogeneity. But media is there kind of supplying information, then people want to grab the information. So you're suggesting volume, but you can also think about search volume. I did run that Granger causality between these two entities. It does seem to be the case that media comes first and then people look at it. So something comes out in the media and then people look at it. So it doesn't seem to be the case that journalists track Google Trends, see what people are interested in, and then talk about it. That's not what I find. It's the opposite. That articles are being generated by the press, okay, and then it catches attention. That's the direction that I saw. Sure. Thank you.
Very interesting and really nice to see it play out so well in practice. This is a very vivid demonstration, so thank you. Similar question to my previous question, how does this fit in with the literature? So for example, some of the stylized facts of overreaction to news since, I don't know, Brown and Harlow 88 was, for example, the asymmetry between good news and bad news, that people tend to overreact much more to negative news. Or, for example, what happens in good times versus bad times. There's evidence that overreaction to news might be different in different market conditions. Do you have any comments on those?
Not maybe in the second one, not so much. Let's put it back one thing at a time. First question is the asymmetry between positive and negative, and I think that's throughout the entire literature. People know we see that people kind of, underreact actually sometimes to negative news, or people kind of there's the disposition effect, and they hold on too much to losers and they dump winners kind of too quickly. I think here we can probably look at it and see. I mean, I don't recall that I found something that's strong. Some of these things happen more in the negative. So you can see here, for example, maybe here you can see the low is stronger than the high. So here you can see maybe again, it's going to be hard for me to kind of really reject that they're the same. I didn't run that test. But it's, at least anecdotally, point estimate seems that the low is stronger. So that's kind of, I think, suggests consistent with what you're saying. The other part was about different market conditions. Again, that's another hard one if you have just 4 years. But when we adjust for beta, we didn't really find much difference between the two. So I think, of course, the question has merit, but the holding horizon here is short. So you see, it's hard to. It's not that I find, maybe. I mean, I should look at it more carefully. But this is really, it's not that we're holding it for 3 months and earnings work better, in good times, bad times. We don't really have that so much here. Please.
Thank you, Professor, for such an interesting topic. And you mentioned there are a lot of fixed effect or the bias you have found in those data. So I'm wondering how you come up with, how do you find those things and how you come up with those hypotheses? Because All of them seems to be very ad hoc, specific. So when the data is coming, must be very messy at the very beginning. So how you find those kind of very ad hoc biases?
It's a great question. You know, some of it is more art than science. Okay, so look, it's a combination. The sentiment stuff, let me take a step back. The challenge with this big data stuff is that you can't really look at it. It's not that I can send you an Excel spreadsheet and you plot it and you look. So, it's a difficult task, and you need to start, using your brain and trying to understand, well, let's, before we use this data, let's try to cut it and look at different effects. So the sentiment is something, look, the mentioning is something we immediately looked at. I mean, okay, let's just see how many firms are mentioned every day. I mean, I think it's something natural. I guess what I'm a former quant now, any quant would just get the data and start looking at it. Do you have this, what kind of coverage do you have? Are all firms covered? Is it the same number every, has it changed significantly from one day or 1 week to the next? And when in the process of doing that, we realized that sometimes you see much more information on the weekends. That's when you see a lot of some media sources show up once a month or once a week, or so that's you can see that in the data in terms of the sheer mentioning. There's a lot of jumps in the data every weekend. Then we found that we said, well, how can that be? We looked at the firms. Well, we saw Apple, Google, all the usual suspects are gonna, they're mentioned more than utilities. So we start, thinking about it that way. We ran some basic tests to see if the data tells us that there's some kind of systematic jumps, and we found that there's a systematic jump in a periodic, for a week or 2 weeks. So that's things that I think you should do in anytime you get some kind of data. So we did those usual adjustments. Then with sentiment is the same. We looked at the different sentiment scorings. We looked at different sentiment for different firms. We did go through a process which is you have to take all of the sources that you have, which is now it's about close to 60,000, and you need to manually categorize them. Okay, are they are they general? Are they business? Are they, what are they? So we have different classifications that we did, and then when we did some simple analysis, we saw that the sentiment statistically, systematically is different between. If you just aggregate all the articles, it just seems for different sources to just have systematically different sentiments. So that's how we start adjusting for these things and think about this, more seriously. We haven't done it yet, but we have information about authors, and I think it definitely makes sense to. We saw anecdotally that certainly some authors have different ways to use language, and they use different tone. So it makes sense to start adjusting for authors, but we haven't done it here. We haven't done it here yet. I think the other approach you can do is maybe kind of machine learning. And I think that's something that, in economists, there's going to be a place where you're going to struggle with that. And I think it could help you. That's why I like guided machine learning, because I think you need to tell someone, where to look. Sometimes the programs can tell you, okay, there's something here, you need to look at it and maybe try to understand it. But I come from the generation that likes to think about the economic problem and then maybe use some tools to maybe sharpen the effect. So typically our way of thinking is first the hypothesis and then kind of look at the data. But as the data becoming larger and larger, maybe there's going to be certainly more room for these kind of machine learning algorithms to tell us where to look first. It's kind of a long answer, but I think it is a real problem. How do you even look at the data? I think that's certainly a really good question. Thank you. Please.
Thanks. Did you treat SEC filings and kind of more complete, larger pieces of corporate communications within that bucket of corporate news? Because it seems to me I've read some places that even though SEC filings frequently do have news content in them, frequently they're not really looked at by the financial community on a timely basis, except when it's like a merger situation or something like that.
We haven't looked specifically at the SEC filings. To the extent that they are, they come up with press releases, we would get it. But most of it, my suspicion is probably we're not getting that. We have been working on other products, other kind of indicators based on. I think people do that now. They kind of look at the accounting statements, SEC filings. We haven't, if it's online, okay, and you can look for it, then we're gonna be able to grab them. But not. For the SEC filings, you're gonna have to get into the website and start scraping the website. We haven't done that for this project.